There is a lie that the sharpest minds in the room often tell themselves. It's a subtle, seductive lie whispered in the quiet moments after a big win or a flash of insight. The lie is that intelligence is a skeleton key, a universal tool that can unlock any door. That because you are brilliant at engineering or surgery or law, you are therefore equipped to be brilliant at everything else. This belief, this quiet poison of the ego, is the single most efficient machine for turning geniuses into fools and fortunes into dust. It's the hidden trap that bankrupts the brilliant. But there is an antidote. It's not a secret formula or a complex algorithm. It's a simple, brutally effective mental discipline practiced by the one man who has outperformed the world's brightest for over half a century, Warren Buffett. And it has nothing to do with being the smartest person in the room. It has everything to do with building a fortress around what you know and having the courage to never, ever step outside. This is the principle of the Circle of Competence, and it is the single most important mental model for anyone serious about making high-stakes decisions, whether in capital allocation, business strategy, or your own personal finance journey toward financial freedom. It is a system for turning raw intellect into repeatable, predictable, world-class results. The core idea is this: your IQ, your degrees, your raw processing power are useless outside of a very specific domain. True power, the kind that compounds wealth and reputation over a lifetime, is not derived from expanding your knowledge to be a mile wide and an inch deep. It is derived from defining the precise boundaries of your expertise, going deeper than anyone else within those boundaries, and having the iron discipline to ignore everything, absolutely everything, that lies outside of them. This isn't about intellectual laziness. It's about strategic focus. It's the ultimate defense against the most dangerous cognitive bias of all for intelligent people: the expert fallacy, the idea that expertise in one field automatically confers wisdom in another. It's the direct countermeasure to the Dunning-Kruger effect, which doesn't just make the incompetent overconfident, but also lures the competent into a minefield of unearned confidence. What we are about to deconstruct is not just an investing strategy. It is a philosophy for navigating a world filled with noise, complexity, and endless temptation. It is a CEO mindset for allocating your most precious resources, your time, your capital, and your mental energy. We will dissect this principle into 5 distinct pillars, each a load-bearing wall in the fortress of rational decision-making. We will begin with the foundation itself, the brutal, unflinching self-assessment required to even begin to draw your circle. The first pillar is the bedrock upon which the entire structure of competence is built. It is the principle of knowing thyself, but in a way that is stripped of all romance and ego. It is about knowing thy limits with a clarity that borders on the ruthless. Most people think self-awareness is about understanding their strengths. The Buffett approach insists that true, actionable self-awareness is about an exhaustive, granular, and unforgiving understanding of your weaknesses and, more importantly, your areas of complete and utter ignorance. It's about being able to say, here is the line, and on the other side of that line, I am a certified amateur. This isn't humility for the sake of virtue. It's humility as a weapon, as a shield against catastrophic error. The market, and the world of business, does not give points for trying. It savagely punishes unearned confidence. To illustrate the devastating cost of stepping just 1 foot over that line, even for the greatest investor in history, we must travel back to 1993. This is the story of Dexter Shoe Company. On the surface, it was a perfect Warren Buffett investment. Here was a rugged, all-American business based in Maine, a company that had never had a down year, that was profitable, that had a strong, simple brand. It was exactly the kind of unsexy, cash-generating business that had made Berkshire Hathaway a legend. The founder, Harold Alfond, was a man Buffett deeply admired, a classic American entrepreneur. And the business had what appeared to be a durable competitive advantage, a moat. In the United States, Dexter was a name you could trust for quality footwear. Buffett was so confident in this assessment that he did something he almost never does. Instead of paying cash, He bought the company outright for $433 million, paid for entirely with shares of Berkshire Hathaway stock. At the time, those shares represented about 1.6% of Berkshire's total value. He wasn't just investing in Dexter, he was making Dexter a permanent part of the Berkshire family, trading a piece of his life's work, a slice of See's Candies, the Buffalo News, and Coca-Cola for this Maine shoe company. In his mind, he was inside his circle. He understood brands, he understood simple manufacturing, he understood American consumers. But there was one variable he fundamentally misunderstood, a variable that lay just outside the perimeter of his expertise. The moat that looked so wide and deep from his vantage point in Omaha, Nebraska, was about to be erased by a force he had failed to properly analyze: the relentless tide of low-cost foreign manufacturing. The competitive advantage of Dexter Shoe was not, as it turned out, its brand. The true competitive advantage was that it was protected by an industry landscape that had not yet been completely globalized. That was changing, and changing fast. Cheap labor from overseas began to flood the market with shoes that were of comparable quality, but at a fraction of the price. Dexter's moat wasn't a castle wall, it was a sandcastle, and the tide was coming in. The business deteriorated almost immediately after Berkshire's acquisition. Its profitability vanished, its competitive edge was annihilated. Buffett, the master of capital allocation, had traded a piece of one of the greatest compounding machines in history for a rapidly melting ice cube. He would later call the Dexter Shoe acquisition the single worst deal he ever made, not just in absolute terms, but in relative terms. He didn't just lose the $433 million, he lost what those Berkshire shares would have become. Years later, he calculated the cost. The shares he had traded for a worthless shoe company would have been worth billions upon billions of dollars. He wrote in his 2007 letter to shareholders, "I gave away 1.6% of a wonderful business to buy a worthless business." The lesson here is profound. Buffett's mistake wasn't a failure of intelligence. He could analyze a balance sheet better than anyone. His mistake was a failure of self-awareness. He mistook his expertise in one area, evaluating American-centric businesses with strong brands, for expertise in another, understanding the complex dynamics of global trade and manufacturing supply chains. He stepped 1 foot outside his circle of competence, and that single step cost his shareholders a fortune. This is the foundational lesson. The perimeter of your circle is a razor's edge, and the penalty for crossing it is severe, swift, and unforgiving. The psychological engine driving this kind of catastrophic error is one of the most well-documented and dangerous phenomena in behavioral science: the Dunning-Kruger effect. Most people have a surface-level understanding of this concept. They think it simply means that stupid people are too stupid to know they're stupid. But that's a gross oversimplification that misses the more insidious danger for intelligent, successful people. The Dunning-Kruger effect is a cognitive bias of illusory superiority that emerges from a person's inability to recognize their own lack of ability. But the true danger is twofold. At the low end of the competence spectrum, you have individuals with very little knowledge who wildly overestimate their own expertise. This is the amateur stock picker who reads one article on a company and suddenly believes they know more than the entire market. But at the high end of the spectrum, the effect manifests in a more subtle and arguably more dangerous way, often called the expert fallacy or intellectual overreach. This is where a person with genuine, deep expertise in one domain incorrectly assumes that their intelligence and skill will translate to other, unrelated domains. A brilliant heart surgeon assumes they can be a brilliant venture capitalist. A world-class software engineer assumes they can be a world-class stock market timer. Their proven competence in one area creates a halo of overconfidence that blinds them to their profound incompetence in another. This is precisely what happened to Buffett with Dexter Shoe. His decades of success in analyzing businesses gave him an earned confidence, but that confidence bled over into an area where his knowledge was superficial. He saw a strong brand and a good balance sheet, familiar signals from within his circle. But he failed to recognize that the fundamental game was being played on a different field, one governed by rules of international trade and labor economics that he did not fully grasp. On a cerebral level, our brains are wired for this kind of mistake. The brain is a pattern-matching machine that craves efficiency. It creates mental shortcuts, or heuristics, to make sense of the world without having to analyze every piece of new information from scratch. When you are a proven expert, your brain has a well-worn set of successful patterns. The danger arises when your brain encounters a problem that looks similar to ones you've solved before, but which contains a critical, hidden difference. Your brain, seeking efficiency, applies the old successful pattern to the new problem. The successful entrepreneur who built a business through aggressive marketing and rapid iteration might try to apply the same model to long-term investing in public markets, a domain that rewards patience and inaction. The result is disaster. The Dunning-Kruger effect in this context is the brain's pattern-matching system running wild, fueled by the ego's desire to believe that I am a smart person, therefore I will be smart about this. The discipline of the Circle of Competence is a conscious, deliberate override of this flawed mental wiring. It is the practice of actively telling your brain, stop. The patterns you recognize here might be illusory. You have not earned the right to have an opinion on this subject. It requires a level of intellectual honesty that is deeply uncomfortable, as it forces you to confront the vastness of your own ignorance. But it is this very confrontation that builds the wall against the kind of billion-dollar mistakes that ego and overconfidence make inevitable. So how do you translate this cautionary tale and psychological theory into a practical tool for better decision-making? The first step is to draw the map of your own mind. You must build a blueprint of your own competence. The most effective way to do this is through an exercise I call the 3 buckets. It is a simple but powerful method for forcing the kind of brutal honesty that this pillar demands. You will need a piece of paper or a blank document, and you will divide it into 3 columns. The first column is labeled rock-solid expertise. This is your inner circle. The criteria for putting something in this bucket are incredibly strict. You cannot just be interested in a topic. You cannot just have read a few books on it. To qualify for this bucket, you must have a level of knowledge so deep that you could teach a graduate-level course on the subject. You understand the history, the key players, the underlying economics, the jargon, and the second and third order effects of any decision within this domain. For a business owner, this might be the logistics of e-commerce fulfillment for consumer packaged goods. For an investor, it might be valuing regional banks with under $10 billion in assets. It has to be specific. Business is not a circle of competence. Technology is not a circle of competence. These are universes. You are looking for your specific solar system, your specific planet. Be ruthless. Most people, if they are being truly honest, will find that this first bucket is very, very small. It might only have 1 or 2 things in it. This is a good sign. It shows self-awareness. The second column is labeled working knowledge. This is the area where you know enough to be dangerous. You can follow a conversation with experts, you understand the basic principles, but you do not have the deep intuitive grasp necessary for high-stakes decision-making. You might understand the general principles of software development, but you couldn't actually architect a scalable system yourself. You might follow the news about the biotech industry, but you couldn't read a clinical trial report and assess its statistical significance. This bucket will be larger than the first. It contains your hobbies, your broad professional knowledge, and subjects you follow casually. The crucial rule for this bucket is that you are forbidden from making significant, unassisted capital allocation or major strategic decisions based on topics in this area. You can use this knowledge to ask intelligent questions of true experts, but you do not act alone. The third and final column is labeled total ignorance. This is your too hard pile. And this, believe it or not, is your most important bucket. The goal here is to be expansive. This bucket should contain almost everything. The future price of gold, the direction of interest rates, the winner of the AI race, the future of cryptocurrency, the politics of the Middle East. Your default position for any new piece of information, any new investment opportunity, any new business trend, should be to place it immediately into this third bucket. It stays here until and unless you undertake a long, disciplined, and rigorous process of study to move it into the second bucket. The mental model is simple in its application. You are only allowed to play in the first bucket. You can seek advice and build teams from the second. You actively and completely ignore the third. This active categorization is a powerful form of risk management. It forces you to pre-commit to a course of inaction in areas where you are most likely to be influenced by emotion, hype, and the Dunning-Kruger effect. It is the first essential step in building the intellectual fortress that will protect your capital and your career from your own worst instincts. To truly appreciate the power of this disciplined approach, we must examine its opposite. We must walk the path of the 99%, the path of the dabbler, the chaser, the person who operates without a defined circle of competence. This is the path that leads not to financial freedom, but to a state of perpetual anxiety and wealth destruction. Let's call this archetype the intelligent dabbler. This individual is often very smart. They might be a doctor, a lawyer, an engineer. They are successful in their own field and have disposable income to invest. Their mistake is that they believe their intelligence is a general-purpose tool. Their investment portfolio or their string of business side hustles becomes a reflection of their ego and the latest headlines. One month, they're pouring money into a cryptocurrency they heard about at a dinner party, convinced they found the next Bitcoin. They don't understand blockchain technology, monetary theory, or protocol security, but they've seen the price chart go up, and their friend is doing it. This is herding behavior in its purest form. When that investment inevitably crashes, they panic sell at the bottom, blaming the market instead of their own ignorance. Next, they read an article about the biotech revolution. They find a small-cap company with a promising-sounding drug for a disease they can't even pronounce. They invest heavily, captivated by the story of a potential 100-to-1 return. They don't have the scientific background to evaluate the clinical trial data, understand the FDA approval process, or analyze the competitive landscape. They are not investing. They are buying a lottery ticket with a good story attached. This is a classic case of being swayed by narrative over numbers. Then comes the hot tech IPO. Everyone is talking about it. The media coverage is breathless. The fear of missing out, or FOMO, becomes overwhelming. They leverage their account to get a bigger position, convinced this is the next Amazon. They have no idea how to properly value a company with no earnings, massive cash burn, and a sky-high valuation based on speculative future growth. They are gambling on sentiment. The portfolio of the intelligent dabbler is a chaotic mess. It's a museum of past market fads. There is no coherent strategy, no underlying philosophy. It is a portfolio built on impulse, emotion, and borrowed conviction. Because they don't truly understand what they own, they have no basis for making rational decisions under pressure. When the market goes up, they are euphoric and overconfident. When the market goes down, they are terrified and paralyzed by fear. They are constantly checking prices, reacting to news alerts, and tinkering with their positions. This high-activity approach is the antithesis of the Buffett mindset. It generates massive transaction costs, high taxes, and unbearable psychological stress. They are playing a game they cannot win because they are playing on a field where they don't know the rules against professionals who do. This path doesn't just fail to build wealth, it actively destroys it, all while consuming enormous amounts of mental and emotional energy. It is the direct consequence of operating without the discipline of a defined circle of competence. The financial consequences of this distinction, operating inside versus outside your circle, are not abstract. They are concrete, quantifiable, and they manifest directly on your balance sheet, your investment portfolio, and the income statement of your business. The direct financial connection is rooted in a single concept: the predictability of future cash flows. The entire practice of valuation, whether for a public company, a private business, or a real estate investment, is based on forecasting how much cash that asset will generate in the future and then discounting that cash back to the present. Your ability to do this accurately is the single biggest determinant of your long-term success. When you operate firmly inside your circle of competence, your forecasts have a much higher degree of certainty. If your expertise is in owning and operating fast food franchises, you have a deep, intuitive understanding of your input costs, labor dynamics, customer traffic patterns, and competitive pressures. You can project your earnings for the next 5 to 10 years with a reasonably narrow range of outcomes. This confidence allows you to make intelligent capital allocation decisions. You know when to reinvest in the business, when to acquire a competitor, and what a reasonable price to pay for that acquisition is. You can sleep at night because your financial future is not based on a wild guess, but on a well-informed projection. This is the foundation of building real, sustainable wealth. Conversely, when you step outside your circle, your ability to forecast cash flows collapses. If that same fast food operator decides to invest in a speculative software company, their projection is no longer a projection. It's a guess. It's a fantasy. They don't understand the technology, the sales cycle, the customer churn rates, or the threat of a new competitor emerging from a garage halfway around the world. The range of possible outcomes for their investment is enormous, from a total loss to a massive gain. This is not investing, it is speculation. On a portfolio level, this translates directly to risk and volatility. A portfolio composed of businesses you deeply understand will have a much lower standard deviation of returns. Not just because the stock prices are less volatile, but because the underlying business results are more predictable. You are insulated from the panic of the market because your conviction is based on your own deep analysis, not on the daily whims of other investors. This allows you to hold on during market downturns and even to intelligently add to your positions when a great business you understand goes on sale. The ultimate financial advantage is that the circle of competence enables the effective use of a margin of safety, another cornerstone of Buffett's philosophy. You can only demand a margin of safety, paying 50 cents for something you know is worth $1, if you can confidently assess that it is in fact worth $1. That confidence is a direct byproduct of competence. The dabbler, the speculator, has no way of knowing the real value, so they can never truly know if they are getting a bargain. They are simply hoping the price goes up. The master of their circle knows the value and can therefore wait patiently for the price to fall well below it. This discipline, born from a humble assessment of one's own limits, is what transforms the chaotic, casino-like nature of the market into a rational field for the systematic building of wealth. Having laid the foundation of self-assessment, we must now move to the second pillar, the construction and defense of your fortress. A circle of competence is not a static concept you define once and then forget. It is a living thing. It must be actively built, maintained, and, most importantly, defended from the constant onslaught of external pressures and internal temptations. Building the wall of your circle requires deep, focused work, not passive consumption of information. And defending it requires a level of discipline that is rare in a world that constantly rewards breadth over depth. The story that best exemplifies this process of meticulous construction is not one of a single brilliant insight, but of painstaking on-the-ground grunt work. It's the story of Warren Buffett's investment in American Express in the midst of the great salad oil scandal of 1963. This event threatened to destroy one of the most trusted financial brands in the world. A company called Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, had perpetrated a massive fraud. They had secured huge loans using barrels of salad oil as collateral. The problem was, the barrels were mostly filled with seawater, with just a thin layer of oil on top. When the fraud was discovered, Allied Crude went bankrupt, and the banks that had loaned them money came after American Express, which had certified the inventory. Wall Street panicked. The consensus was that American Express would be on the hook for massive liabilities, potentially enough to bankrupt the entire company. Its stock price was cut in half. The fear was palpable. This was a crisis of confidence, the ultimate test of a financial brand. For most investors, this was a situation firmly in the too hard pile. The legal ramifications were complex, the potential losses unknowable. But for Buffett, this was a situation that fell directly on the border of his burgeoning circle of competence. He understood banking, and he understood the power of a consumer brand. The key question for him was not about the intricacies of warehousing law. It was about whether the scandal had damaged the core business that mattered, the traveler's checks and credit cards. So he did what almost no one else on Wall Street was willing to do. He got out of his office and did his own primary research. He didn't just read analyst reports or news clippings. He went to the source. He went to restaurants and hotels. He visited banks. He talked to merchants. He would go to a steakhouse and ask the cashier if they were still seeing plenty of customers paying with their American Express card. He would visit a bank branch and ask the tellers if they were still selling traveler's checks at the same pace. He even had his partners at his small investment partnership do the same in their own cities. The feedback he got was overwhelmingly positive. The scandal, it turned out, was a Wall Street story, a story for the financial pages. For the average consumer and merchant, nothing had changed. The American Express brand, their trust in the little green card and the traveler's checks, was completely unshaken. People were still using the products just as they had before. He had discovered that the company's fundamental economic engine was insulated from the warehousing division's disaster. Armed with this ground-level conviction built not on speculation but on first-hand evidence, he made a massive bet. He invested nearly 40% of his partnership's capital into American Express stock. It was an incredibly concentrated, high-conviction investment. And it paid off handsomely. The stock roared back as the market realized the company would survive, and Buffett made a fortune for his partners. This story is the perfect blueprint for how a circle of competence is built. It's not built through passive reading. It's built brick by brick, through deliberate, focused effort to understand the reality of a business, separate from the noise and narrative of the market. Buffett fortified his circle, not with complex financial models, but with real-world conversations and observations. He didn't need to be an expert in maritime law. He needed to be an expert in the durability of consumer psychology, and he went out and tested his thesis in the real world. The psychological forces that Buffett had to overcome in the salad oil scandal are the very same ones that lead most investors and decision-makers astray. The two most powerful are confirmation bias and the availability heuristic. Confirmation bias is our deep-seated tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs or hypotheses. If you believe a company is doomed, you will subconsciously seek out news articles, forum posts, and expert opinions that validate that belief, while dismissing or ignoring any evidence to the contrary. In the case of American Express, the pre-existing belief on Wall Street was, this company is facing catastrophic liabilities. Investors were actively looking for confirmation of this doom, and they found it in every scary headline. Buffett's genius was to actively fight this bias. Instead of looking for reasons the company would fail, he went out to test the hypothesis that its core business would survive. He actively sought disconfirming evidence by asking the one question that mattered: have customers stopped using the products? When the answer was no, he had a rational basis for his investment, one that was immune to the prevailing narrative. The second cognitive bias at play is the availability heuristic. This is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic, concept, method, or decision. We overweight information that is recent, vivid, and easily recalled. The story of the salad oil scandal was dramatic, shocking, and widely reported. It was highly available in the minds of investors. the image of a bankrupt American Express was easy to conjure. The much more mundane, boring reality that millions of people were still quietly using their traveler's checks every day was not a vivid headline. It was a dispersed, non-dramatic fact that required effort to uncover. Therefore, the market overreacted to the available, scary news and underreacted to the less available, fundamental reality. Buffett's process of doing on-the-ground research is a powerful antidote to both of these biases. It forces you out of the echo chamber of your own mind and the media. It forces you to confront the world as it is, not as it is portrayed. This is a core component of high-level strategic thinking. It's about building a decision-making process that systematically filters out these distorting, psychological shortcuts. Defending your circle of competence means building a habit of questioning the readily available narrative and actively seeking out the ground truth, even if it requires painstaking, unglamorous work. It's about building your conviction on a foundation of reality, not on the shifting sands of market sentiment. This is how you develop the temperament required for long-term success in any field defined by uncertainty and risk. To build and fortify your own circle of competence requires a practical, repeatable method. It's not enough to simply say, "I will do more research." You need a structured process. A powerful mental model for this is what I call the 50-hour rule. This rule states that before you are allowed to commit any significant capital or resources to a new investment or business venture that is on the edge of your circle, you must first commit to a minimum of 50 hours of deep, focused study. This acts as a barrier to impulsive decisions and ensures that your entry into a new domain is based on a solid foundation of knowledge, not a fleeting whim. Here is how you can break down those 50 hours into a concrete action plan. The first 10 hours are dedicated to history. You must understand the history of the industry you are entering. Who were the original players? What were the major technological or strategic shifts over the past 50 years? Which companies won and which ones failed, and why? History provides context and reveals patterns that are invisible if you only look at the present. Reading a book like The Fish That Ate the Whale before investing in the fruit industry, or studying the railroad booms and busts of the 19th century before investing in a new infrastructure project provides an invaluable long-term perspective. The next 10 hours are for financial immersion. You must read the last 5 years of annual reports, including the shareholder letters, for the top 3 public companies in that sector. This is non-negotiable. Annual reports are the single most valuable source of information. They teach you the language of the industry, the key metrics that matter, and the primary risks the leaders are worried about. This process alone will put you ahead of 90% of other investors. The third 10-hour block is for qualitative understanding. This means listening to industry-specific podcasts, watching interviews with the top CEOs, and reading trade publications. Your goal here is to understand the culture, the current zeitgeist, and the qualitative factors that don't show up on a balance sheet. What do the smartest people in this field talk about? What keeps them up at night? This helps you understand the competitive dynamics and the human element driving the industry. The fourth 10 hours are dedicated to ground truth. This is your version of Buffett's American Express investigation. You must talk to customers of the products or services. If it's a software company, sign up for a free trial. If it's a retail chain, go visit the stores. If it's a business-to-business service, find people on LinkedIn who are users and ask them for 15 minutes of their time to share their experience. This primary research is invaluable for cutting through corporate marketing fluff and understanding the real user experience. The final 10 hours are for a pre-mortem and risk analysis. Before you invest a single dollar, spend 10 hours actively imagining that the investment has failed catastrophically. Write down every single reason why it could have gone wrong. A new competitor emerged, the technology became obsolete, the key management left, the government changed a regulation. Then, for each of these failure scenarios, assess its probability and severity. This exercise, pioneered by psychologist Gary Klein, is a powerful way to counteract overconfidence and force yourself to see the risks you might have overlooked in your excitement. By the time you complete this 50-hour process, one of two things will have happened. Either you will have uncovered a fatal flaw and decided not to proceed, saving yourself a costly mistake, or your conviction will be so strong and so well-founded that you will be able to act decisively and sleep soundly, knowing you have truly done the work to bring this new area inside the fortress wall of your competence. The antithesis of this methodical, diligent approach is a character we see everywhere in the modern business and investing world: the guru chaser. This is the individual who, lacking the desire or discipline to build their own circle of competence, attempts to outsource their thinking and rent conviction from someone else. They are intellectually lazy, and they pay a steep price for it. The guru chaser subscribes to multiple stock-picking newsletters, each promising to reveal the secret formula for wealth. They follow charismatic personalities on social media who flash expensive watches and rental cars, promising to share the trades that will make you rich. They pay for expensive weekend seminars that claim to teach them how to get rich in real estate, or forex trading, or some other complex field in just 2 days. The fundamental flaw in the guru chaser's approach is that they are confusing information with knowledge, and knowledge with wisdom. They might get a stock tip, but they have no understanding of the underlying business. They have none of the deep, contextual knowledge that the guru supposedly possesses. Therefore, they have no real conviction of their own. This lack of personal conviction is a financial time bomb. When the stock they bought on a tip goes down 20%, what do? They have no basis for making a decision. They don't know if this is a temporary dip and a buying opportunity, or if the fundamental thesis has broken and it's time to sell. They are paralyzed. Their only recourse is to check the guru's social media feed, hoping for an update. They have abdicated their role as a decision maker and become a follower, a sheep in a flock. This is the opposite of the CEO mindset. It is a mindset of dependency. True leadership skills, whether in managing a company or managing your own portfolio, are about developing the ability to make sound judgments under conditions of uncertainty. The guru chaser actively avoids developing this skill. They are always looking for a shortcut, a magic bullet, a way to get the reward without the work. The financial consequences are devastating. They are perpetually late to every trend, buying at the peak of the hype cycle created by the guru, and selling in a panic when the narrative changes. They are susceptible to every market fad and every get-rich-quick scheme. They are not building wealth, they are merely transferring their own capital to the people selling them the dream. They fail because they never build their own fortress. They are renting a room in someone else's, and they can be kicked out at any moment. The hard truth is that you cannot borrow conviction. You must build it yourself, brick by painful brick, through the hard work of expanding and defending your own circle of competence. The direct financial connection of building this fortress wall is the effective application of what Benjamin Graham, Buffett's mentor, called the margin of safety. This is the most important concept in investing, and it is utterly dependent on the existence of a well-defined circle of competence. The margin of safety principle is simple. Do not buy an asset unless its market price is significantly below your conservative estimate of its intrinsic value. If you calculate a business is worth $1 per share, you don't buy it at 98 cents. You wait until you can buy it for 50 or 60 cents. That gap, that 40 or 50 cent cushion, is your margin of safety. It is what protects you from bad luck, unforeseen events, and, most importantly, errors in your own judgment. But here is the critical link. You cannot have a margin of safety if you do not have a confident and reasonably accurate estimate of intrinsic value. And your ability to estimate intrinsic value is a direct function of your circle of competence. If you are operating outside your circle, any valuation you perform is just a guess. It's garbage in, garbage out. The confidence required to invest a large portion of your capital into a single idea only comes from knowing that your estimate of value is based on a deep understanding of the business. When Buffett invested in American Express during the salad oil scandal, he had a high degree of confidence that its intrinsic value was far, far higher than the market price. This confidence wasn't arrogance. It was earned through his diligent, on-the-ground research. That research fortified his circle, which in turn allowed him to calculate a reliable intrinsic value, which then allowed him to recognize the enormous margin of safety being offered by the panicked market. This creates a powerful financial advantage. The investor who stays within their circle only needs to make a few decisions over their lifetime. Because they insist on a large margin of safety, their downside risk on each investment is minimized, while their upside potential is substantial. This asymmetry, low risk, high potential return, is the holy grail of investing and strategic decision-making. The dabbler, the guru chaser, has no access to this asymmetry. Because they don't know the true value of what they are buying, they often buy at prices far above intrinsic value, creating a, quote, margin of danger. They are taking on high risk for a low potential return. Over time, this mathematical reality grinds their capital down to nothing. Building the fortress wall of your competence is not an academic exercise. It is the essential prerequisite for the single most powerful wealth-building technique there is: buying wonderful assets at a price far below what they are worth. It is the very engine of long-term financial freedom. With a defined and fortified circle, we arrive at the third pillar, which is perhaps the most counterintuitive and powerful of all: the weaponization of ignorance. This is the ability to take your well-defined circle of competence and turn it into an offensive tool. How? By developing the superpower of saying no. In a world that glorifies action, diversification, and being involved in every new trend, the discipline to say no to 99.9% of opportunities is what separates the amateur from the professional. It is the ultimate expression of focus and the greatest preserver of capital and mental energy. There is no story that illustrates this principle more starkly than Warren Buffett's conduct during the dot-com bubble of the late 1990s. It was a period of mass euphoria, the internet was changing the world, and a new paradigm of business was supposedly being born. Companies with no profits, no revenues, and sometimes no real product were achieving market valuations in the billions of dollars. It was a gold rush, and everyone was getting rich. Wall Street analysts, tech gurus, and the media were all united in their message: get in or get left behind. And in the middle of this frenzy stood Warren Buffett, doing nothing. He was publicly, relentlessly, and viciously mocked. He was called a dinosaur, a relic of a bygone era. A famous magazine cover depicted him as out of touch, unable to grasp the new economy. He was losing money for his investors relative to the soaring NASDAQ index. The pressure on him to abandon his principles and join the party must have been immense, almost unbearable. His response to this criticism was simple, consistent, and infuriating to his detractors. He would say, in essence, "I don't understand it. I have no idea how to value these companies. I can't tell you what a company like Pets.com or Webvan is going to be earning in 10 years. And if I can't do that, I can't figure out what it's worth today. So I don't invest." He wasn't saying these companies were bad. He was just saying they were outside his circle of competence. His expertise was in businesses with long track records of profitability and predictable earnings, like insurance, soft drinks, and furniture stores. The economics of high-tech, high-growth, no-profit internet startups were a mystery to him. So he put them in his too-hard pile and said no. He chose to look foolish in the short term to avoid looking bankrupt in the long term. And then, in March of 2000, the bubble burst. The NASDAQ, which had peaked above 5,000, began a brutal, soul-crushing collapse. It would eventually fall nearly 80% from its peak. Those high-flying internet darlings, the companies that were supposed to define the new economy, were wiped out. Trillions of dollars of speculative wealth vanished. The people who had mocked Buffett were financially ruined. And Warren Buffett, with his coffers full of cash from the boring, old economy businesses he understood, was left standing. His discipline to say no, a discipline born directly from his adherence to his circle of competence, had not only saved his shareholders from catastrophic losses, but had also positioned him to be greedy when others were fearful in the aftermath. This is the weaponization of ignorance. It's the understanding that admitting "I don't know" is not a sign of weakness, but a statement of immense strategic power. It allows you to sidestep the manias and panics that destroy the wealth of the overconfident masses. The psychological force that makes saying no so difficult is one of the most powerful and primitive drivers of human behavior: herding and its modern cousin, FOMO, the fear of missing out. Humans are social animals. For millennia, our survival depended on our ability to stick with the tribe. Being ostracized from the group was a death sentence. This ancient wiring is still deeply embedded in our brains. When we see a large group of people acting in a certain way, especially if they appear to be benefiting from that action, like getting rich in a stock market bubble, a powerful subconscious instinct screams at us to follow them. This is social proof. The brain's shortcut is, if everyone is doing it, it must be the right thing to do. To stand apart from the herd, to say no when everyone else is shouting yes, is to fight against millions of years of evolutionary programming. On a neurological level, FOMO is very real. Brain imaging studies have shown that the experience of being excluded or missing out on a potential reward triggers activity in the same regions of the brain that process physical pain. Your brain literally interprets the feeling of being left behind as a threat. The dot-com bubble was a perfect storm of these psychological forces. You had a compelling narrative. The internet is changing everything. Social proof, my neighbor, my cousin, that guy on TV are all getting rich, and a constant stream of media reinforcement. The pressure to join the herd was immense. Buffett's Circle of Competence acted as a logical, unemotional override to this powerful instinct. His mental framework was simple. Does this opportunity fall within the circle of things I understand deeply? If the answer was no, the decision was made. The emotional noise of the market, the pain of FOMO, the sting of public criticism, all of it was irrelevant. The system was binary. This is why having a predefined circle is so critical. You make the decision in a time of calm and rationality, so that you can rely on it in a time of chaos and emotion. Without that pre-commitment, your primitive brain will take over. You will be swept up in the mania. You will buy at the top and sell at the bottom. You will become a victim of the market's emotional tides. The discipline to say no is not an intellectual skill. It is a temperamental one, and it is a skill that can only be built on the bedrock of a clearly defined and rigorously enforced circle of competence. It is your shield against your own worst instincts. To operationalize this principle, you need to transform the act of saying no from a difficult, emotional decision into an automatic default process. The mental model for this is creating a physical or metaphorical too-hard pile. This concept, which comes directly from Buffett and his partner Charlie Munger, is one of the most effective productivity and risk management tools an executive or investor can have. Here is how you implement it. You establish a set of simple, non-negotiable criteria for what constitutes a too-hard problem. Any new business idea, investment opportunity, or strategic initiative that comes across your desk is first filtered through these criteria. If it triggers any of them, it goes immediately into the too-hard pile. There is no further analysis. There is no, let me just take a quick look. It is an immediate and final rejection. What are some of these criteria? First, if you cannot explain the business or the investment to an intelligent 12-year-old in 60 seconds, it goes into the pile. This is the ultimate test of clarity. If you can't explain it simply, you don't understand it well enough. Complex jargon and buzzwords are red flags for a lack of fundamental understanding. Second, if the long-term success of the venture depends on a factor you cannot predict or control, it goes into the pile. This could be the future direction of a commodity price, a pending regulatory decision, or the outcome of a complex scientific trial. You want to bet on business execution, not on a roll of the dice. Third, if the business has no history of profitable operations, it goes into the pile. This is the Buffett filter that kept him out of the dot-com bubble. He preferred to bet on the proven winners, not the speculative hopefuls. For a venture capitalist, this rule would be different, but for a value investor, it is paramount. Fourth, if you look at the key decision makers and you wouldn't feel comfortable having them marry into your family, the opportunity goes into the pile. This is the Munger rule. Business is a human endeavor, and betting on people of low integrity, no matter how brilliant, is a losing game in the long run. The power of the too-hard pile is that it automates the process of saying no. It converts it from a willpower-draining exercise into a simple, Unemotional filtering mechanism. This frees up your most valuable asset, your mental bandwidth. Instead of wasting time and energy analyzing hundreds of mediocre or incomprehensible opportunities, you can focus all of your attention on the rare few that sail cleanly over your high hurdle and land squarely in the middle of your circle of competence. This is how you achieve extraordinary results, not by making hundreds of good decisions, but by making a handful of great decisions and avoiding thousands of bad ones. The too-hard pile is the system that makes this possible. It is the practical application of weaponized ignorance. The path of the 99% stands in stark contrast to this focused, deliberate inaction. The average investor or entrepreneur is a victim of what is often called activity bias, or action addiction. They believe that to be successful, they must always be doing something. Their default setting is yes, not no. This manifests in a constant flurry of motion that creates the illusion of progress, but ultimately leads to ruin. The action-addicted investor is a frequent trader. They are constantly watching the market, listening to financial news, and adjusting their portfolio. They buy a stock on Monday, sell it on Wednesday, and buy something else on Friday. They believe that this high level of activity is a sign of engagement and skill. In reality, they are just racking up enormous transaction costs and taxes, and making decisions based on emotional noise rather than fundamental analysis. Their portfolio is in a constant state of churn, never allowing the magic of compounding to take root. The action-addicted entrepreneur suffers from the same affliction. They are constantly chasing the next new thing. They launch a new product line, then immediately pivot to a new marketing strategy, then decide to enter a new geographic market, all in the span of a few months. They cannot stick with one strategy long enough to see it bear fruit. They suffer from shiny object syndrome, where every new idea seems better than the one they are currently working on. Their business lacks focus and strategic coherence. Their resources are spread thin across a dozen mediocre initiatives instead of being concentrated on the one or two that could be truly great. This bias towards action is deeply ingrained. In most corporate and social environments, being busy is seen as a badge of honor. Someone who sits quietly in their office, reading and thinking, is often perceived as unproductive. The person who is constantly in meetings, firing off emails and making deals is seen as a high performer. But as Buffett has shown, true success in investing and long-term business strategy often comes from long periods of apparent inactivity, punctuated by rare and decisive action. The path of the 99% is a path of frantic, unfocused energy. It's like a hamster on a wheel, running faster and faster but never actually going anywhere. The path of the master is one of patience, discipline, and the courage to do nothing until the perfect opportunity arises. The too-hard pile is the braking system that stops the hamster wheel, allowing you to step off and survey the landscape with clarity and purpose. The financial impact of mastering the art of saying no is one of the most dramatic in all of business and finance. It directly influences a company's or a portfolio's return on invested capital, ROIC, which is a key driver of long-term value creation. Imagine you are a CEO or an investor with $1 million of capital to allocate. The world presents you with a constant stream of opportunities. Opportunity A is in a field you barely understand and has a projected return of 8%. Opportunity B is a complex turnaround situation with a 12% projected return, but a high degree of risk. Opportunity C is a Me Too expansion project with a 6% return. The action-addicted manager, feeling the pressure to do something, might allocate a third of their capital to each of these projects. Their average return would be a mediocre 8.6%, and they have taken on significant risk in areas outside their core expertise. The master of the Circle of Competence, armed with their too-hard pile, looks at these three opportunities and says no, no, no. They recognize that none of these meet their high standards. They are mediocre ideas that lie outside their deep expertise, so they do the hardest thing. They wait. They let the cash sit on the balance sheet, earning next to nothing. This may look foolish to the outside world, but they are not waiting for a good opportunity. They are waiting for a great one. Then, 6 months later, an opportunity arises that is a perfect fit. It's a fat pitch, right down the middle of the plate, squarely inside their circle of competence. It's an acquisition of a small competitor in their core market, a business they understand, inside and out. They can confidently project a 20% return on this investment with a high degree of certainty. They then deploy their entire $1 million into this single, high-conviction idea. The financial difference is stark. The frantic dabbler earned a mediocre return on a portfolio of poorly understood risks. The patient master earned a spectacular return on a single, well-understood risk. Over a lifetime, this difference in approach is the difference between stagnation and exponential wealth creation. By saying no to hundreds of mediocre ideas, you preserve your capital, your time, and your focus for the handful of truly brilliant ideas that will generate the vast majority of your returns. This is the essence of great capital allocation. It is not about being busy, it is about being decisive when it truly matters. And that decisiveness is only possible when you have the discipline to ignore everything else. The first 3 pillars have established a defensive and disciplined framework, but a fortress can also be a prison. The 4th pillar addresses a crucial question: how do you grow? How do you prevent your circle of competence from becoming a circle of complacency? The answer is that the circle is not meant to be static. It must be expanded, but it must be expanded intelligently, methodically, and with the same discipline used to defend it. This is the reconnaissance mission, the patient, deliberate process of learning and exploration that precedes any major commitment of capital or resources. The perfect case study for this intelligent expansion is Warren Buffett's journey to investing in Apple. For decades, technology was the canonical example of an industry that was firmly in Buffett's too-hard pile. He famously avoided tech stocks during the dot-com bubble, stating he had no edge in understanding their fast-changing competitive dynamics. He was a master of brands, insurance, and railroads, not semiconductors and software. So when Berkshire Hathaway began accumulating a massive stake in Apple starting in 2016, many observers were stunned. Had the old master finally changed his stripes? Had he abandoned his lifelong principles? The answer is no. This was not a sudden conversion, it was the culmination of a long, patient reconnaissance mission. Buffett didn't wake up one day and decide to become a tech investor. Instead, he watched the technology industry evolve until a part of it, a very specific part, evolved into something he too panahondered understand. He didn't try to learn Apple's technology, he learned its business model. He watched as the iPhone transformed from just a piece of hardware into the centerpiece of an incredibly powerful and sticky ecosystem. He saw millions of people building their digital lives around this single device. He observed the brand loyalty, the pricing power, and the recurring revenue from services like the App Store. And he had a flash of insight. He realized that Apple, in its mature stage, was no longer a classic, unpredictable technology company. It had become a consumer products company. And not just any consumer products company, but perhaps the greatest one in history. He began to see the iPhone not as a piece of complex electronics, but as the modern equivalent of a pack of Coca-Cola or a Gillette razor blade, a product with immense brand loyalty and a deep, enduring moat. The stickiness of the Apple ecosystem, he realized, was a competitive advantage he understood intimately. He knew how to value a business that locks in its customers and can consistently raise prices. This was a language he spoke fluently. He had spent his entire career studying businesses exactly like this. The expansion of his circle was not a leap into the unknown. It was an adjacent move. He waited for the territory of technology to change until a piece of it bordered his own familiar kingdom of consumer brands. He then undertook a deep study of that specific piece, leveraging his existing knowledge to understand it. He didn't need to know how the A12 Bionic chip worked. He needed to know the probability that a loyal iPhone user would switch to an Android phone. That was a question he was uniquely qualified to answer. This is the model for intelligent expansion, not through reckless exploration, but through the patient observation of adjacent fields, waiting for an opportunity that allows you to leverage your existing core competence as a bridge into a new domain. The psychological mechanisms behind this kind of intelligent expansion are rooted in the concepts of deliberate practice and the Baader-Meinhof phenomenon, also known as the frequency illusion. When you first decide to learn about a new industry, let's say the railway business, you suddenly start seeing it everywhere. You notice news articles about freight volumes. You overhear conversations about logistics. You see the logos of railroad companies on trains you hadn't paid attention to before. This is the frequency illusion. Your brain, having been primed to look for this new topic, begins to highlight it in your everyday sensory input. This can create a positive feedback loop for learning. However, this passive observation is not enough. To truly expand your circle, you must engage in what psychologist Anders Ericsson famously called deliberate practice. This is not the same as simply putting in hours. Deliberate practice is a highly structured activity, the explicit goal of which is to improve performance. It involves constantly pushing yourself just beyond your current abilities and seeking immediate feedback on your performance. Casual reading about an industry is not deliberate practice. Building a detailed financial model of a company in that industry, making a projection, and then tracking its actual results against your projection, that is deliberate practice. It creates a tight feedback loop that accelerates learning and exposes the flaws in your understanding. Buffett's approach to learning is a masterclass in this. He famously spends the majority of his day reading. But he is not reading passively. He is an active reader, constantly asking questions, connecting new information to his existing mental latticework of business models, and testing his own hypotheses. When he studied Apple, he wasn't just reading tech blogs. He was analyzing its financial statements, thinking about its brand from the perspective of his See's Candies investment, and considering its ecosystem in the context of what he knew about American Express. He was engaged in a slow, methodical, and deliberate process of integrating a new subject into his existing web of knowledge. This is the crucial difference between dabbling and learning. A dabbler skims the surface of many topics. A master in training goes deep, engaging in the hard, focused work of building real, functional knowledge. The expansion of your circle of competence is not an accident. It is the result of a conscious, structured, and sustained effort, combining the natural pattern matching of your brain with the rigorous discipline of deliberate practice. To apply this principle of intelligent expansion to your own career or investments, you need a systematic process. A highly effective mental model for this is the adjacency expansion method. It's a step-by-step blueprint for growing your circle of competence without taking reckless leaps into the unknown. Step 1. Define your core. Before you can expand, you must have an incredibly clear and specific definition of your current circle of competence. Use the 3 buckets exercise we discussed earlier. What is the one thing in your rock-solid expertise bucket? Let's say, for example, your core competence is digital marketing for direct-to-consumer e-commerce brands. Be as precise as possible. Step 2. Identify the adjacencies. Now brainstorm all the fields that are directly adjacent to your core. An adjacency is a field that shares key characteristics, business models, or customer bases with your current area of expertise. For our e-commerce marketer, adjacencies might include logistics and fulfillment for e-commerce, software as a service for e-commerce analytics, content creation for social media platforms, or private equity firms that invest in consumer brands. You are looking for areas where your existing knowledge provides you with an unfair advantage in learning. Step 3. Begin a structured reconnaissance program. Choose one of these adjacencies to explore. Now apply the 50-hour rule to this new field. Spend 50 hours in a structured learning program, studying the history, reading the annual reports, listening to the experts, talking to customers, and performing a pre-mortem. The crucial rule during this phase is that you are forbidden from committing any significant capital or making any major career changes. This is purely a learning phase. You are on a reconnaissance mission, not an invasion. Your goal is to build a solid foundation of working knowledge in this new adjacent field. Step 4. Look for the linchpin. As you learn, you should be actively searching for what is called a linchpin opportunity. This is a single investment, business idea, or project that acts as a bridge between your old circle of competence and the new adjacent field. For our e-commerce marketer studying logistics, a linchpin might be investing in or joining a startup that provides a software solution to help e-commerce brands manage their inventory. This opportunity allows them to leverage their deep understanding of the customer, the e-commerce brands, while simultaneously deepening their operational knowledge of the new field, logistics. This method provides a safe and effective way to grow. You are not jumping into a completely alien environment. You are taking a single calculated step from a position of strength. Each successful expansion of your circle then creates a new base from which you can identify further adjacencies, leading to a lifetime of compounding knowledge and opportunity. It transforms personal and professional growth from a random walk into a strategic campaign. The path of the 99% offers a cautionary tale of how not to expand. The common mistake is falling prey to shiny object syndrome. This is the curse of the intellectually curious but undisciplined mind. The individual suffering from this syndrome is in a constant state of excitement about new possibilities, but lacks the focus to see any of them through. 1 month they are convinced that dropshipping is the key to financial freedom. They buy a course, build a basic website, and then, when they don't see immediate results, they lose interest. The next month, they hear about the incredible potential of artificial intelligence. They start reading articles about machine learning, convinced this is their new calling. They might even enroll in an online introductory course. But soon, the initial excitement fades as they encounter the reality of the hard work and deep mathematical knowledge required. Then, a friend tells them about a can't-miss opportunity in commercial real estate. They abandon their AI studies and spend a few weeks looking at properties, quickly becoming overwhelmed by the complexity of financing and property management. Their journey is a series of enthusiastic beginnings and quiet abandonments. Their knowledge base is a mile wide and an inch deep. They mistake this breadth of superficial interest for a well-rounded skill set. In reality, they are a master of nothing. They are vulnerable in every field they enter because they lack the deep, foundational knowledge required to navigate its unique challenges and risks. This behavior is often driven by a desire for novelty and a fear of missing out on the next big thing. It is the antithesis of the patient, methodical adjacency expansion model. Instead of building on a strong foundation, they are constantly trying to lay new foundations on unstable ground. In business, this leads to strategic drift and a waste of resources. In investing, it leads to a portfolio of speculative bets on industries the investor does not truly understand. Shiny object syndrome is a failure of strategic thinking. It prioritizes the thrill of the new over the compounding power of the deep. It is the fast track to becoming a jack of all trades and a master of none, a fatal combination in a world that disproportionately rewards deep expertise. The financial distinction between intelligent, adjacent expansion and the chaotic chase of shiny objects can be understood through the lens of diversification versus what the legendary investor Peter Lynch famously called diversification. True diversification is the practice of spreading investments across various financial instruments, industries, and other categories to reduce risk. The goal is that if one asset or sector performs poorly, the impact on the overall portfolio is limited. Intelligent expansion of your circle of competence is the foundation of effective diversification. As you methodically expand your expertise from, say, regional banks to insurance companies, you gain the ability to add a new, uncorrelated asset class to your portfolio that you deeply understand. This genuinely reduces your overall risk without sacrificing your potential for high returns, because you are still operating from a position of knowledge and can demand a margin of safety in both sectors. Diversification, on the other hand, is the practice of adding assets to your portfolio simply for the sake of adding them, without any real understanding of what you are buying. This is the path of the shiny object chaser. They buy a little bit of crypto, a foreign stock, a commodity ETF, and a biotech startup, not because they have any expertise in these areas, but because a financial advisor told them they need to be, quote, diversified. This practice often increases time risk rather than decreasing it. Why? Because the investor has no idea how to manage these new assets. They don't know when they are cheap or expensive. They don't know the specific risks associated with them. They don't know when to sell. They have simply acquired a collection of things they don't understand. This leads to a false sense of security. When a crisis hits one of these sectors, the investor is flying blind and is likely to panic at the worst possible moment. The ultimate goal of a sophisticated wealth management strategy is not just to acquire assets, but to build a portfolio of high-quality, well-understood assets that can be managed intelligently over the long term. This is how true, lasting wealth is built. The adjacency expansion method is the engine of this strategy. It allows you to slowly and carefully add new pillars of understanding to your financial house, resulting in a structure that is both larger and more stable. The alternative, diversification, is like building a house by adding a new room in a completely different architectural style every year. The result is not a mansion, but a chaotic, unstable, and ultimately worthless mess. We have now arrived at the fifth and final pillar. This is the culmination of the entire philosophy, where the principles of self-knowledge, fortification, disciplined inaction, and intelligent expansion converge to create an almost unbeatable competitive edge. This pillar is about understanding how the strict adherence to your circle of competence gives you a profound asymmetric advantage in a world consumed by noise, speed, and complexity. It is about how this simple discipline allows you to be rational when others are fearful, and to act with decisive force when the perfect opportunity finally appears. The ultimate demonstration of this asymmetric advantage occurred during the darkest days of the 2008 financial crisis. The global financial system was on the brink of collapse. Lehman Brothers had failed. AIG was bailed out. The stock market was in a freefall. Fear and panic were everywhere. The very foundations of capitalism seemed to be cracking. For most people, this was a time of terror and paralysis. But for Warren Buffett, it was a time of opportunity. Amidst the chaos, he received a phone call from the CEO of Goldman Sachs, one of the most prestigious investment banks in the world. Goldman was not in immediate danger of failure, but its stock was being pummeled as investors lost faith in the entire financial sector. They needed a vote of confidence, and they needed capital. They needed the Warren Buffett seal of approval. Buffett's decision-making process in this moment of extreme crisis is a masterclass. He was not trying to understand the complex credit default swaps or collateralized debt obligations that had caused the crisis. That was outside his circle. He simplified the problem down to a few core variables that were squarely inside his circle. First, he asked himself, is the United States government going to let the entire American financial system collapse? He reasoned that the answer was a definitive no. The consequences would be too catastrophic. He was making a bet on the long-term survival and self-interest of the American system itself. Second, he asked, will the Goldman Sachs brand, over the long term, survive and thrive? He knew that Goldman had one of the strongest brands and some of the smartest people in the world of finance. He was betting on the durability of a premier institution. He wasn't betting on their quarterly trading profits. He was betting on their long-term institutional power. Because he was operating with clarity and confidence from within his circle, and because he was one of the few people in the world with both the capital and the courage to act, he was able to demand extraordinary terms. He invested $5 billion in Goldman Sachs. But he didn't just buy common stock. He bought preferred stock that paid him a 10% dividend annually, $500 million a year, just for showing up. He also received warrants that gave him the right to buy $5 billion worth of common stock at a fixed price in the future. It was an incredibly lucrative deal. a one-way bet that was only available because the rest of the world was consumed by a panic he refused to participate in. His circle of competence was not just an intellectual filter, it was a psychological fortress. It insulated him from the contagious fear that had paralyzed everyone else, allowing him to calmly and rationally assess the situation and act with overwhelming force. This is the ultimate unbeatable edge, the ability to maintain your temperament and execute your strategy precisely when everyone else has lost their mind. The psychological principle that underpins this unbeatable edge is the interplay between the focusing illusion and the paramount importance of temperament. The focusing illusion is a cognitive bias that occurs when people place too much importance on one aspect of an event, causing them to misjudge the other aspects. During the 2008 crisis, the world was focusing on a single, terrifying thing: the potential for systemic financial collapse. This intense focus on the immediate threat blinded them to the long-term reality. They forgot that great businesses would survive, that the American economy was resilient, and that moments of maximum pessimism are also moments of maximum opportunity. Their field of vision had narrowed to a pinprick of fear. Buffett, shielded by his mental framework, was able to resist this illusion. He could zoom out and see the bigger picture. He focused not on the immediate chaos, but on the long-term constants: the power of the U.S. government and the durability of a great brand. This ability to choose your focus is a direct result of operating from a base of deep competence. When you don't understand a situation, your brain, in a state of threat, will naturally focus on the most salient, scary piece of information. When you do understand the fundamental drivers, you can consciously direct your attention to the things that truly matter for the long term. However, this intellectual clarity is useless without the right temperament. J.P. Morgan was once asked what he thought the stock market would do. He famously replied, "It will fluctuate." This simple statement contains a universe of wisdom. The world of business and investing is, by its very nature, volatile and emotional. The greatest challenge is not intellectual. It is emotional. It's the ability to remain calm and rational when you are losing money and everyone around you is panicking. It's the ability to resist the urge to get greedy when the market is euphoric and your taxi driver is giving you stock tips. This is temperament. And it is far rarer and more valuable than intellect. Your circle of competence is the ultimate tool for cultivating this temperament. Because your conviction is based on your own deep work and understanding, it is not easily shaken by the noise of the market or the opinions of others. You have an anchor in the storm. The 99% who operate on borrowed conviction and superficial knowledge have no anchor. They are tossed about by every wave of fear and greed. This is why, in the final analysis, the greatest advantage in any high-stakes field is not a high IQ, but a stable, disciplined temperament. The entire system of the Circle of Competence is designed to build and protect this very quality. To forge this unbeatable edge in your own life, you must adopt a mental model that prioritizes survival above all else. The most powerful tool for this is the practice of inversion, a concept championed by Charlie Munger. Instead of asking, "How can I achieve success?" you invert the question and ask, "What is most likely to cause me to fail, and how can I avoid it?" This focus on avoiding stupidity, rather than seeking brilliance, is the secret to long-term survival and success. You can operationalize inversion through a specific downside-first checklist. Before making any major investment, career change, or business decision, you will go through this checklist. Step 1. List all potential failure points. Instead of writing a business plan that outlines all the ways you will succeed, write a failure plan. List every single thing that could go wrong. Your key supplier could go out of business. A new technology could make your product obsolete. The economy could enter a deep recession. Your star employee could quit. Be brutally pessimistic. Generate a list of at least 20 potential failure points. Step 2. Map failure points to your competence. Now, go through your list, one by one. For each potential cause of failure, ask yourself a simple question. Is this risk factor something that falls squarely inside my circle of rock-solid expertise? For example, if one risk is that your customers' tastes might change, and you have 2 decades of experience in consumer marketing, you can confidently say yes. But if another risk is a complex change in international patent law, and you are not a lawyer, the answer is a clear no. Step 3. The inversion veto. This is the final and most important step. If there is even one major, plausible failure point on your list that falls outside your circle of competence, you must veto the entire project. You do not proceed. You do not try to mitigate the risk, you simply put it in the too hard pile and walk away. This seems extreme, but it is the ultimate form of risk management. It ensures that you are only taking risks that you fully understand and are equipped to handle. It systematically eliminates the unknown unknowns, the hidden dangers that lie outside your field of vision, which are the very things that cause catastrophic business-ending failures. By inverting the problem and focusing on what can go wrong, you are forced to confront the limits of your own knowledge. This checklist makes the abstract concept of a circle of competence into a concrete, actionable decision-making tool. It is the final gatekeeper that protects you from your own ambition and overconfidence. The antithesis to this disciplined, inversion-focused approach is what can be called the complexity fetish. In many fields, particularly finance and academia, there is a pervasive and dangerous belief that complex problems require complex solutions. This leads to a preference for things that are sophisticated, jargon-filled, and difficult to understand. The thinking is, if it's this complicated, it must be smart. The hedge fund manager who uses a 20-factor quantitative model to trade obscure derivatives is seen as more intelligent than the investor who simply buys and holds a portfolio of wonderful, easy-to-understand businesses. The business strategist who creates a 100-page slide deck filled with complex diagrams and buzzwords is seen as more impressive than the leader who has a simple, clear vision that everyone in the company can understand. This fetish for complexity is a trap. Complexity creates fragility. A system with 100 interdependent moving parts only needs one of them to fail for the entire structure to collapse. The complex financial models used by banks before 2008 were a perfect example. They were intellectually brilliant, but they were built on a few simple, flawed assumptions about housing prices. When that one simple assumption proved false, the entire complex edifice crumbled. Simplicity, on the other hand, creates robustness. A business model that is simple and easy to understand is often more durable because it has fewer points of failure. Buffett's core businesses, insurance, utilities, consumer staples, are all fundamentally simple. Their success does not depend on 1,000 variables all going right at once. The 99% are often seduced by complexity because it appeals to the ego. Understanding something complex makes you feel smart. But the true master knows that the highest form of intelligence is not the ability to understand complexity, but the ability to see the simple, powerful truths that lie beneath it. The circle of competence is the ultimate tool for achieving this clarity. It forces you to reject the siren song of complexity and to stick with the simple, powerful ideas that you can understand from the ground up. It is the discipline of preferring the robust and simple over the fragile and complex. This is the final key to building an advantage that can withstand the test of time. Ultimately, the direct financial connection, the grand prize for a lifetime of disciplined adherence to these 5 pillars, is the uninterrupted magic of compounding. Albert Einstein supposedly called compound interest the 8th wonder of the world. It is the engine that turns modest savings into vast fortunes. But this engine has one critical vulnerability: it must not be interrupted. A single catastrophic loss can undo decades of patient progress. A 50% loss requires a 100% gain just to get back to even. The greatest financial benefit of the Circle of Competence philosophy is not that it helps you find the highest returning investments, but that it is the single most effective system ever devised for avoiding these catastrophic, portfolio-destroying mistakes. By knowing your limits, you avoid the Dexter shoe-type errors that vaporize capital. By fortifying your circle with diligent research, you avoid buying into frauds like the salad oil scandal. By weaponizing your ignorance and saying no, you sidestep the speculative manias like the dot-com bubble that wipe out the undisciplined. By expanding intelligently, you avoid diversification into assets you don't understand. And by focusing on inversion and avoiding complexity, you build a robust system that can withstand the inevitable shocks and crises the world will throw at you. Each of these pillars is a layer of armor protecting your compounding machine. Imagine two investors. Investor A chases performance. They earn 30% one year, then lose 40% the next, then make 50%, then lose 60%. Their path is a violent, stressful roller coaster that goes nowhere. Investor B operates within their circle. They aim for a consistent, reasonable return of, say, 15% per year. They never have the spectacular highs of Investor A, but more importantly, they avoid the devastating lows. Over 30 or 40 years, Investor B's unbroken chain of compounding will result in a fortune that dwarfs anything Investor A could ever dream of. This is the final promise. The Circle of Competence is not a get-rich-quick scheme. It is a get-rich-for-sure system. It is the slow, steady, and certain path to true and lasting financial freedom. It is the ultimate expression of a CEO mindset, a framework for leadership and strategic thinking that transforms the chaotic game of chance into a winnable game of skill. You have just invested a significant amount of your most valuable asset, your time, to download a powerful piece of mental software. You have moved beyond the simple idea that intelligence is the key to success and have grasped a much more profound truth. The real advantage, the unbeatable edge, lies in understanding the limits of your own intelligence. You have absorbed the 5 pillars of the Circle of Competence: the brutal honesty to know your limits, the diligence to build and defend your fortress, the courage to say no, the methodical patience to expand intelligently, and the temperamental discipline to turn it all into an asymmetric advantage. This is not just a theory. It is a practical, actionable system for making better decisions in every area of your life. But it is crucial to understand that what you have just mastered, as powerful as it is a single node in a much larger network. Warren Buffett's success is not the result of one mental model, but of a latticework of interconnected models that support and reinforce one another. The Circle of Competence tells you where to play, but other models, like margin of safety, inversion, and understanding second-order consequences, tell you how to win once you are on the right field. You have just been given a crucial piece of the map. But a single piece is not the whole territory. The video that is now on your screen is not an accident. It is the next piece of that map. It is the link that connects the principle you have just mastered to the next layer of the system. Think of it as the key that unlocks the next room in the fortress of rational thought. The journey to mastering this way of thinking is a process of assembling this mental arsenal, piece by piece, until you have a complete, unbreakable framework. The choice you have now is simple. You can click away, satisfied with the powerful tool you have just acquired. Or you can continue the ascent. You can choose to forge the next link in the chain. This is not about watching another video. This is a decision about who you want to become. Someone who collects interesting ideas, or someone who builds a complete, devastatingly effective mental toolkit for winning. If you are serious about that ascent, the next step is right there, waiting for you. Complete your arsenal. Click and continue the journey.